Hi, and welcome back to video 2 on just why wholesale priced DCF payments are better. I'm going to give you several key ways that illustrate the value proposition of these higher yield payment streams so you can put it into context just what a great opportunity these payment streams are. But first, I got to give you a little warning. DCF stands for discounted cash flow, and that's math. Now, before your eyes glaze over, I promise that I won't get into the details of how to calculate internal rate of return or net present value on this video. The more important thing is that math proves that these payments do more for you and for your portfolio, and they're a better deal than almost anything else available in the industry. I want to show you how they stack up compared to other options and products that you might have seen, and compare these payments so you can make an informed decision. If you want to have a one-on-one session with me and look at a deep dive into a specific payment stream and really get into detail on the math, I would welcome it. Just hit a time on my calendar and I look forward to talking with you. But for most people, math is a little hard, so I'm not going to get into the specifics of it and bore you on this video. I started out warning you about the math, but in reality, I got many customers who are engineers and finance people who really appreciate the math and see how these discounted cash flow payments are simple and how they can be calculated and quantified using any spreadsheet or calculator. It's so unlike many other annuity offerings. Many people are surprised at really actually how simple it is. I think the annuity industry does a real disservice to customers because they make so many other products exceedingly complicated and really difficult to understand with crediting methods, payout rates, indexes, and roll-ups that are just hard to quantify. You're going to find that these wholesale income contracts are refreshingly simple by comparison because they do exactly what they say they're going to do. That's it. So let's jump in and get started. All right, welcome to the second video, and this video is really just all about why these are better payment streams. In the first video, I'm going to recap real quickly. We're talking about DCF payments, which are known in a variety of different ways in the marketplace. DCF income payments, wholesale income, secondary market annuities. Some other people call them in-force annuities. It's the same, the different words for the same thing, which are period certain guaranteed payments from top-rated insurance companies that come from structured settlements and that are transferred from original payees to buyers like myself and to you in secondary market transactions. Buyers sell for a discounted lump sum today, and purchasers acquire the right to receive these existing in-force payment streams at a discounted price, which means a higher yield. Higher yield means a better outcome for you. It's a higher yield than bonds, typically more stable from a price standpoint because they're fixed guaranteed payment streams at a fixed rate of return. They're typically a higher yield than new annuities like MYGAs, SPIAs, and FIAs, which for those of you not versed in the alphabet soup of the insurance world, MYGA stands for multi-year guarantee annuity, which is also known as just a fixed annuity. SPIAs are single premium immediate annuities, which are the most common type of lifetime income annuity, or sometimes period certain as well. They're just a single premium for an immediate start payment. FIA stands for fixed indexed annuities, which come in a wide range of options with income riders and benefits and crediting methods and all kinds of complexity. I like simple, and simple in this case has a higher yield, and that is a better outcome in my book. Hopefully in your book as well. Also, these have higher yield than CDs. I'm going to get into the various different comparisons here. So in addition to higher yield, we've got lower risk, and lower risk, again, is a better outcome. We have a lower price than comparable annuities, and we have a lower risk for market volatility and sequence of returns risk on portfolios when you use period certain and guaranteed income. That also limits your risk of overspending, which is also known as a withdrawal rate risk. These are kind of esoteric risks that can be hard to talk about and hard to face when comparing apples to oranges. In this case, a fixed income to a variable level of income from like a 60-40 bond portfolio, 60-40 stock and bond. But in your typical 60-40 stock bond Wall Street cookie cutter advice, you're carrying a lot more risks than you might be aware of. So these payment streams are better than many of the alternatives. Like I said, better than bonds, better than annuities, better than CDs, and better than that 60-40 portfolio. Those are the four main points that we're going to get into here. So let's start with annuities. Better than an annuity in the sense that we have a lower price and a higher yield. At the time of this video, this is comparing a 20-year, $1,000 a month payment stream. A new issue annuity is coming out at a yield of about 4.9%, and in our marketplace, we're seeing yields about 6% for that payment stream. Lower price, higher yield. $141,000 versus $152,984. Which one do you like? I'd pay $141 before I paid $152. I don't know about you, but that would save you $11,599 based on rates today. It's pretty good savings. So you can do this math to compare yourself as well. Let's pull over to the screen here, and we'll look at immediate annuity quotes and fixed annuity rates just for grins. Let's compare. I'm going to bring my screen over here, and we'll look at immediate annuity rates for period certain payment streams. We're going to only look at the period certain payments, so it doesn't matter your age, or in most cases it doesn't matter your age or state, but I'm not 60, but I'm going to go ahead and say that I am here, and we're going to start right away. Let's look at monthly income of $1,000 a month, and we're going to look at more annuity quotes because we want to look at the 20-year period certain. So $1,000 a month for a 60-year-old male in Montana, $152,660 is the cost based on today's rates from our friends at Immediate Annuities, and yeah, it's come down a little bit. $152,660 when I did the slide. It was $152,984, but that's still only $300. I'll still take that $11,000 savings. So you can do that math. It varies with time, but I'm consistently about 1 to 3% higher yield than comparable annuity offerings, new issue annuities. So there's a good reason to always consider the secondary market for payment streams. Sorry for the zooming in and out here, but now let's look at those MYGAs, those multi-year guarantee annuities. Again, from my friends at Immediate Annuities, you're seeing some 10-year rates pretty high, 5.6, 5.25, 4.1, a little bit all over the map here. 7 years at 3.6, 4.1, 4.5. You get the idea. Rates are all over, but they are in the, let's say, they're in the low threes to mid fives, whereas in our marketplace we're in the mid fives to mid sixes for fixed annuity rates. So again, higher yield, lower price. So now there are definitely some points when when primary annuities are better, fixed or variables or indexed annuities. And I'm just going to touch on a couple of them. If you have limited assets or you really need lifetime income, by all means, buy a lifetime income product like a single premium immediate lifetime income or a deferred income lifetime annuity. Lifetime income is incredibly important. I find that a lot of customers considering the secondary market already have lifetime income or they have sufficient assets to effectively manage their longevity risk. So if you need lifetime income, get it taken care of. I'm never going to advise somebody to not have it. But if you've already got it, you've already got a pension, Social Security, or a bunch of assets, or other sources of income, or rental property, chances are good that you don't need more lifetime income because you'd be buying an insurance outcome that you don't need to insure. Don't cover a risk if you don't have a risk that you don't need to cover. In addition, in this inverted yield curve environment, short-term options, 1 to maybe even 3 years for the lump sums, you're as well off, if not better off, in a primary annuity because rates are really good on short-term stuff right now. If you're looking for 1 year money, I'm not the best place for it. It's not something my marketplace does a lot of paper in, and you can find good options in CDs or in short-term annuities. Also, short-term primary annuities offer short-term liquidity options such as partial surrenders. So a fixed annuity may be a better option for you there if you need that 10% withdrawal every year. And again, if you're a Swiss Army knife kind of person, if you like bells and whistles, features, riders, and options, and you don't really care about real dollar appreciation, then choose a fixed index annuity with a lifetime income rider and a complicated benefit structure with all kinds of stuff. Let me know if you can sort out those contracts. I can't make sense of them, but you might, and they do offer a lot of bells and whistles that some people really, really like. Let's step on to the next comparison of comparing my product to a bond. Now, bonds are great. Bonds are corporate guarantees or treasury guarantees, and they have a yield. And that yield is typically referred to as a coupon or an interest payment. And at the end of the term, you get your principal back. If you're to make an apples to apples comparison here, we got to look at holding a bond in a yield to maturity manner, meaning buy a 25-year bond at the beginning and hold it all 25 years. And that's what I've shown here. You have $1 million in a bond and it's at 4% or 4.8%. You're getting $4,000 a month in interest. Now it may be paid quarterly or annually, but you get the idea. You've got your income along the way, and at the end you get your money back. When you compare that to the DCF income or these wholesale income priced contracts, this is a concept which kind of like buy term and invest the difference. I'm saying buy term income and invest the difference here. And instead of buying all bonds and living just off the bond coupon and getting your $1 million back, what if you bought an asset that paid you the same monthly income guaranteed for the same period of time, and you invested the difference in the stock market, or pick your own thing. I'm going to illustrate the stock market not because I'm advising you to invest in the market, but just because it's something that you can compare to. So just look at the total U.S. stock market or an index fund that tracks the market. You can do so at practically no cost using index funds. I'll illustrate the VTI, which is a Vanguard fund. And if you invest the difference in price to generate the same income, you've got $350,775 to invest. If you're just putting that into the markets and letting it sit there with no withdrawals and no risk of taking it out, yes, it's going to go up and go down. We don't know how much it's going to go up, but we can use tools to illustrate that. And when you illustrate it, you'll see that whereas in the bond portfolio you end up with your $1 million back, using this you could end up with $3,268,000, and that's sort of a middle of the road average on thousands of scenarios using this portfolio visualizer tool to illustrate the market. And let me go to that screen right now, and we'll illustrate what I'm talking about here. So Portfolio Visualizer is a free tool that anybody can use, and there's a wide range of tools on this website. But we're using a Monte Carlo simulation, which is a way of looking at historical rates of return on the market over a wide range of scenarios and time frames. And what I've set up here, like I showed in that previous slide, if you bought a payment stream that accomplishes the income you need and you invested the difference, that was $352,775 of investment. And you can track asset classes. You can just say stock market or bond market in here. I said the Vanguard VTI fund. I'm not recommending it, but it's one that a lot of people are familiar with and has a super low expense ratio, and you can simply buy that as a market proxy. So we'll illustrate that for 25 years. There's no withdrawals coming out of this. Remember, this was a buy term income and invest the difference kind of scenario. And investing the difference in this market tracking fund, you can run the simulation, and it comes back with different amounts every time specifically, but in general they're coming in right about this same $3.2 million level that I showed in that previous slide. Here it's 3.1, 3.25. It just depends on what sets of returns are generated by the computer when it runs the scenarios. But this is meant to illustrate something relatively simple. If you buy a bunch of bonds you'll get your income, over time, and you'll get your $1 million back. If you take the same $1 million, you buy a term income and invest the difference in the market, you could have quite a bit more dollars back at the end of the run. And that's a concept, a wholesale income advantage concept that we illustrate in a couple of different ways. And I'll do another way of it in just a minute. But first, before I go there, I wanted to look at CDs, which is another investment option that people are looking at for safe money options. Now, I said a few minutes ago that if you're looking for a short investment, CDs might be a better option for really short money, from 1 year, 2 year, 3 year. But in looking at a 5-year rate, we are, as I said, like 1 to 3% higher than 5-year CD rates. So right now, a $100,000 investment in a 5-year CD at a 4.9 rate gets you $127,528 in payout. You have early withdrawal penalties and a lower yield and a higher purchase price than when you compare it to one of our payments. Same $100,000 investment at a 6% yield gets you $134,000 payout. This is just a higher yield and a lower price. Now, you can do the math on this just as we did on the other examples. Let's go back to that screen. Here's some CD rates for 5 years. 4.8, 4.5, 4.35. In fact, I don't even see a 4.9 here anymore. When I did the slide, there was a 4.9 and I picked the best, but we've now come down to 4.5, 4.35. As I said, there are certain situations where, for example, really short, you might be better off. 5.1. Let's be honest, if you've got 1 year time horizon, don't buy a 5-year CD, buy a 1 year CD. 5% is a great rate of return. I don't have typically 1 year, 2 year payment streams. They're just not the strong suit of this particular market. So there are certainly situations where these things make more sense, where primary market things like a primary market annuity or primary CD make sense. You can do the math on our calculator to verify those sorts of numbers. So here we are on the calculator on our website, and I'm going to just do a real quick illustration of a 6% investment in a CD of how much is it going to pay out on a $100,000 investment in 5 years is going to be $20.29, and we solve for that at 6%. Oops. Happy problem. One too many zeros. $100,000 investment at 6%, 5 years, 134, and 4.9%, like you'd find on that slide, on 27 of investment. Those are where these numbers come from if you're looking to compare apples to apples. This sort of analysis, I just did that right on our calculator. You'll see a lot more of this calculator over time in other videos as we move ahead. I think I touched on these points as well when CDs or bonds are better. If you've got a short horizon, or if you have partial liquidity and you might need to sell, or you absolutely must have FDIC coverage. Choose your CDs for the FDIC coverage. If you must sell, if you need the liquidity options, definitely choose your bonds. You'll have a penalty if you sell a CD. And if you have a short-term horizon, CDs and bonds might be a better option. But for locking in a great rate of return for a longer period of time, 5 years or more, we're definitely better than bonds or CDs for that. Now, a minute ago, I was talking about comparing a pure bond income to buying term income and investing the difference in the market. Not entirely a fair comparison, because if you're all in bonds and looking at coupons only for income, you probably might not like the stock market. So let's look at a more common scenario. Typically the most, overused advice on Wall Street, the cookie cutter Wall Street kind of commentary is 60-40 stock bond portfolio, 4% withdrawal rate, and you're exposing yourself to market risk and volatility all along the way. And sometimes your income might have to go down if you have bad years. You've got sequence of return risk. But that's what Wall Street and in its infinite wisdom will give you for advice. We're going to go back over to that Monte Carlo simulation and look at this advice. On this slide, it's got about a $2,430,000 ending account value. And remember, Monte Carlo simulations change with every illustration. But when you do that, we'll just replicate it here so you can see. We're going to say $1 million, and we're going to withdraw a fixed amount of $3,300 a month monthly for 25 years, and we're going to be in 60% stocks and 40% in bonds. And incidentally, I've got quite a few videos that do this at length. I'm not going to belabor this point in this video, because if you're interested in this comparison, I'd be happy to walk through it with you one-on-one, or you can see our case study spotlight videos as well that detail this. But this is where this $2.4 million comes up with that you saw on that previous slide as your potential 50th percentile ending account balance. Worst case scenario in historical time frames, it's almost depleted. Best case, $7 million. We're just going to take the middle of the road here. Your mileage will vary, and this is just for illustration purposes. But the next step on this illustration was this slide. What if you bought term and invested the difference? By term income and invest the difference. So $521,566 for wholesale income. Let's look where that came from, okay? Remember, we're saying 25 years of income, and 25 years of income at today's rates are about 6%, real briefly. And we'll see more of this inventory page in a minute, but here's a 30-year, 29-year at 6.25, 6.1, 20-year at 6.0. So this is a pretty safe guesstimate. So 6% interest rate, $3,300 a month for 25 years. Hit solve, and this is the rate that it comes back with. 6.25 costs a little less, but we're going to just do 6% on this. And that's where $521,566 comes from. That leaves a difference of $478 in your $1 million starting portfolio. So we're buying term income, $520, and we're investing the difference. We're going to invest it in the stock market. Not that I'm recommending this, but it's just for illustration purposes here. Once you've removed the pressure from your portfolio to produce income, remember, all your income's taken care of over here. You've removed the pressure, so you can take this money, you've bought term income, and you can just set the remainder, the savings, aside. Let it run. Let the portfolio grow over time, and let's see what that says. See what that does. We're going to put 100% in that, and we're going to get rid of the bond allocation because we don't need it, and we are not taking money out. So we've removed the pressure for income on that 478, 434 remainder savings, if you will. Now let's run it. What does it say? We come back in a middle of the road 50th percentile allocation of $4,342,595. Run it again, it'll come back with a somewhat different number, but 4,388. In the slide, I had 4,402 when I ran this illustration. That's a $1,972,148 difference. That's more output, more stability for the same level of income, 81% more account value to be exact. That is an enormous difference by just simply buying term income and investing the difference. You've got your same income on both sides here. You eliminate the market volatility. You eliminate the sequence of returns risk. You eliminate the timing risk. And it's just a much, much better financial outcome. That's what we talk about with this wholesale income advantage of using term income bought at a wholesale price, investing the difference, and coming out better for it. So you can learn a little bit more about this sequence of return risk. I'm not going to bore you with the academic research on this, and there is quite a lot of it, but illustrating investor 1 and 2 here, investor 1 has a 15% decline during the first 2 years of their retirement. I'm sure everyone looking at this video has had a 15% decline in their portfolio. When those bad years happen is critical. If you're in retirement and you're counting on your assets for retirement income and you hit some of that bad patch, your portfolio, this guy runs out in year 17 and a half. This guy's got the same 15% return. It's just 10 and 11 years in. Nice and stable along the first 10 years. That portfolio lasts way out past the screen, probably past life expectancy. And this is the difference between success and failure. When you're in the markets and you're depending on your market-based investments for income to buy groceries, in those early years, you're just on the roulette table, gambling with your future. You can learn more about this from Schwab or from any number of other places. Just Google sequence of return risk. And people will talk about it. Not many people give you a solution like what I've just shown you. We looked at that inventory page for a second. We were just on a calculator page, and I flashed to the inventory. We're going to spend more time on the inventory page in another video here. But I just wanted to illustrate that some of these concepts like sequence of return risk and the money, time value of money, they're all illustrated in the downloads section of that inventory page. So click over there. There's a bunch of great downloads that you can utilize to study up on this market and understand how these payment streams can work for you. They work in a variety of relatively simple ways. I call them income now, income later, and lump sum income options. We use the income now for retirement income needs depending on your age. That might be starting now or starting somewhat in the future, income later, with deferred income cases. And then using lump sums, we can create options. Those options can be a house remodel, college tuition, new car like I've shown here, or they can be simply lump sum investments that mature in the future and allow you or your heirs to make other investment decisions at that time. I just don't like a lot of the options in primary annuity markets where, for example, if you buy a lifetime income stream and you die early, that income stream can be lost to the insurance company, like a premium. And that's no fun. I prefer to see your money stay with you and your heirs for them to do as they see fit with. So the next step in these payment streams with DCF payments is to start thinking about what your investment goals are. You may be 5 or 10 years from retirement, so a deferred income, one of those income later cases, can work for you. You might want to be maximizing Social Security, so you need to fill a gap between now and when Social Security reaches its highest level for you. Every situation is a little bit different, but these period certain guaranteed payment streams are great for a wide range of planning situations. And I'm going to go into detail in the next video on some of these case studies from customers I've had over the years that should help really clarify some of your thinking. But get started thinking about what your goals are so that you can match the payment streams that we have to what might work for you. Now, to be fair, these definitely aren't for everyone. These are higher yield fixed income assets, and they're great for people who are comfortable making their own decisions and buying from available inventory, but they're not new issue annuity policies. They're not particularly well known. The market's only about $1 billion a year, and most of it is sucked up by firms like J.G. Wentworth and a couple of Wall Street private equity firms that use most of the inventory for bond issuances and securitizations. Interestingly, insurance companies themselves are the main buyers of aggregated pools of these receivable payment streams. So the insurance companies know how good it is, and they buy it for their own general investment fund. But I want you to ask your own questions, do your due diligence, read some of that paperwork. I showed you the downloads page. You can also make an appointment to speak with me at any time, look at specific cases or your own situation. These things are great, and they might be for you if you want this safe, higher yield fixed income. It's a better alternative to bonds and CDs like we just looked at in this video. It helps you lower your portfolio and sequence of return risk and eliminate some of that volatility risk and gives you more financial output. In the next video, I'm going to touch on some portfolios of payments and planning situations with customers and actual case studies from situations I've encountered over the last almost 14 years now in this industry using these different types of payments. I look forward to talking to you on that next video. And before I go, just wanted to remind you that this is coming from DCF Exchange. We're a capitalized buyer trading millions of dollars a month in this space. We distribute through a nationwide network of financial advisors, and our inventory is in stock. It can be split and customized to your needs. We really streamlined and simplified the sales process and accommodate non-qualified cash buyers as well as IRAs and qualified funds. We've had over 830 customers with almost 2,100 files sold over the years and about $430 million, give or take, in future payments with no customer ever losing a penny. So I look forward to working with you and seeing you in the next video. So thanks for watching the second video in this series. I hope by now you can see how these higher yield payment streams from top-rated insurance companies stack up against safe money offerings like CDs, new issue annuities, and managed portfolios. In so many ways, what we offer is just plain better. It's a better yield at a better price with a better outcome. And you get that all with lower risk from market volatility and a really important mitigation of the sequence of returns risk. This is a risk that many people just might not know about because advisors sometimes have a hard time explaining it. And it's kind of dry and esoteric, but it's a real killer. The first 5 years of retirement are the red zone where bad returns in those years can decimate a portfolio. If you're relying on that portfolio for income, then you are fully exposed to market volatility and the sequence of return risk. You can be devastated by some bad years early on. But using period certain income streams like what I've just shown you, instead of a market-based withdrawal rate, you can extend the life and the security on your portfolio out for decades. So stay tuned in the next video because we're going to look at how others have used these assets individually and in portfolios to achieve some amazing outcomes. I'll see you on the next video. So to get started, contact your advisor today, and we look forward to working with you.